is your historical tax liability? One of the most important and most often overlooked steps in the sales tax compliance process is understanding this detail. If you've already determined your nexus footprint, then you know the states where you have the obligation to collect and remit taxes. You also know the dates when that obligation began. Once you know these two things, you can start assessing whether you owe any sales tax for prior periods, and if so, how much. If you have physical nexus in a state, meaning you have inventory, an employee, or some other physical presence, your obligation to collect sales tax begins from day one. There's no grace period. You should be collecting tax from the moment that physical presence is established. But with economic nexus, it works a bit differently. The obligation starts once your sales activity in that state crosses the economic threshold. And what happens next depends on the state. Some states provide a grace period between the time you cross that threshold and when you need to register. Others require you to begin collecting tax on the very next transaction. For example, in Tennessee, once you exceed the $100,000 threshold, your collection obligation begins on the first day of the third month following the month you went over that threshold, but not before July 1st, 2017. In Michigan, your collection obligation begins on January 1st of the year following the year you exceeded that threshold. And with many other states, there's no grace period at all. You're expected to collect tax on the next taxable sale after crossing the threshold. Understanding when your obligations began is key because that's what defines your historical liability period, which is the span of time when you should have been collecting sales tax, but you did not. If you've been selling into a state where you were required to collect sales tax but didn't, then you've technically undercharged your customers for taxable sales. That means you still owe that tax to the state even if you didn't collect it from your customers. This is what's referred to as your historical sales tax liability, which is the amount of uncollected taxes that the state could assess you for if they reviewed your records. And that amount can grow quickly once you factor in penalties and interest, often referred to as P&I. When you go back to calculate what you owe, you're not just looking at the sales tax itself, you're also responsible for penalties and interest for late payment. Each state has its own rules, but most penalties are calculated as a percentage of the tax due, and in some cases, the total can add up to 25% of that amount or more. Interest compounds over time, and when combined with penalties, the total liability can become significant, especially if you've been operating for multiple years without collecting tax in a state. That's why it's so important to understand your exposure early and address it before a state discovers it for you. Another key reason to identify your historical liability is the risk of audits. If a state discovers that you've been doing business there without registering or filing returns, you could be subject to a sales tax audit. In that situation, you'll be required to pay all past taxes due, plus the full amount of penalties and interest. Audits can be time-consuming, expensive, and stressful. And let's face it, there's never a good time for an audit. The best way to avoid that scenario is to identify and resolve potential liabilities before an audit ever happens. Being proactive puts you in control and gives you options that you won't have if a state initiates contact first. Fortunately, understanding and addressing your historical liability doesn't have to be overwhelming. Once you've identified the states where you have nexus and the dates when your obligations began, you can start putting together a look-back analysis. This involves reviewing your historical sales data, identifying where and when you had an obligation to collect, and estimating the total amount of tax that would have been due. Because this process can be complex, it's best to consult a sales tax expert when you're completing your look-back analysis. That can help you interpret each state's rules correctly, ensure your calculations are accurate, and advise you on the best path to compliance. Don't do this step alone. After your look-back analysis is complete, You'll have a clear picture of what your potential exposure looks like, and at that point, you can decide how to move forward, whether that means registering and starting to collect proactively or addressing past liabilities directly. And here's the good news. There are often ways to reduce penalties if you take action before a state reaches out to you. Many states offer programs that encourage voluntary compliance and provide penalty relief for businesses that come forward proactively. Interest generally still applies, but reducing or eliminating penalties can meaningfully lower the total cost of getting compliant. So if you've recently determined your nexus footprint and suspect there may be historical exposure in a few states, don't panic. Knowing your historical liability is not about assigning blame. It's about taking ownership and protecting your business from future risk. Once you understand where you stand, you can take the right steps to minimize what you owe, bring your business into compliance, and avoid unexpected surprises down the road. But how do you take advantage of those penalty relief and proactive voluntary relief programs that the states offer? Well, for more on that, check out this video. And remember, when in doubt, always consult with a sales tax professional.